Hello and welcome back to Stocks with Connor, the podcast where I talk about all things related to the stock market. Whether you're an experienced investor or just starting out, hopefully this podcast will provide you with some semblance of valuable information in order to navigate the complex world of stocks. In this episode, I'll be going over the different types of brokerage accounts, including both individual accounts and retirement accounts. I'll also be going over what a stock quote consists of and how to look at stock quotes. I'll then talk about stock charts and explain the main types of stock charts. And then finally, I'll go over the main types of trading, as well as the pros and cons of different types of trading and investing. Within the world of the stock market, there are two main types of accounts that you can have: an individual brokerage account and a retirement account. Within the classification of an individual brokerage account, there's both cash and margin accounts. Both of these accounts allow you to buy stocks, bonds, mutual funds, ETFs, and all of the main investment vehicles that you'd want to invest in for yourself. These accounts allow you to invest in whatever you want, whenever you want, without really any restrictions. Additionally, you can withdraw your money at any time without any penalties. Money you make in these accounts is taxed at the long-term capital gains rate for stocks you hold for more than a year, and the short-term capital gains rate for stocks you hold for less than a year. The main difference between a cash and margin account is the amount of leverage that you're allowed to use. In a cash account, you have to have the entire amount of your investment ready to invest before you can buy anything. This means that if you want to buy $100 worth of stock, you have to have $100 in your account that has fully settled. Every stock purchase and sale takes roughly 2 days to settle on the stock market, meaning that when you sell something, you have to wait the full 2 days to be able to buy it back on a stock or on a cash account. Because of this, you also can only spend as much money as you have in your account on stocks, meaning that you have no leverage at all. On the other hand, a margin account allows you to take out leverage on your trades. Most margin accounts allow you to take up to 100% leverage, meaning that for every $1 in your account, you can buy $2 worth of stocks. Investing with margin is very risky, and it makes it easier to lose money since you have more money at stake than you have in your account. The other main advantage with a margin trading account is it allows you to take positions in options that you would not be able to take with a cash account. I'll talk about how these function in a later episode, but the basic idea is multiple options trading strategies, you need to have margin in your account to be able to trade them, which you cannot do in a cash account. The other main category of stock accounts is retirement accounts. Within the category of retirement accounts, there are other types of accounts, including a 401k, traditional IRA, and Roth IRA. Retirement accounts are essentially a tax-advantaged trading account that allows you to be taxed less on your investments in order to help save for retirement. 401ks are an employee-sponsored retirement plan that allows you to contribute some of your pre-tax money from your paycheck. This means that you're able to be taxed less on money that you're investing rather than being taxed before you put it into your account. This money is taxed when you take it out of the retirement account, and you can only take money out of this account once you reach the retirement age. Many employers will also offer a contribution match to your 401k, which means that when you put money in, they'll also put extra money into your retirement account to encourage saving for retirement. There's also a limitation on 401k contributions, which as of this year is $20,500 per year. Similarly to a 401k, traditional IRAs also take pre-tax money. Traditional IRA contributions have a limit of $6,000, and the money that you contribute to your traditional IRA account can be deducted from your taxable income, which reduces your taxes come tax season. In a traditional IRA, you are also taxed when you take your money out of the retirement account. Finally, a Roth IRA is the final main type of retirement account, which instead of taking pre-tax money, takes taxed money. The main benefit of this is that you are not taxed on the money that you take out of the account, meaning that any dollar that grows in that account is tax-free when you withdraw it. The maximum contribution for a Roth IRA is also $6,000, but there are income limits. So if you're making more than $140,000 individually or $208,000 for filing jointly, you are no longer able to contribute to your Roth IRA. As a whole, retirement accounts are a very good way to save for retirement, as these accounts have advantages in terms of tax, but they're not for everyone at every point, and you should be investing in individual account as well as tax-advantaged retirement accounts. The next main topic I wanted to talk about was stock charts and stock quotes. A stock quote is essentially a snapshot of a stock's current market price and other relevant information about the particular stock. Some of the information typically displayed on a stock quote is the ticker symbol, the last price, the change in that stock on a given day, the opening price, the high and low of the day, the volume, and the market cap of the stock. The ticker symbol is the unique code that identifies a stock on the stock market. So for example, Apple's ticker symbol is AAPL. The last price is the most recently traded price of a stock on the given stock exchange. The change is the difference between the last traded price and the previous day's closing price. The opening price is the price that was taken for the very first trade of the day in a given stock. The high and low are also fairly self-explanatory, as they are the highest and lowest prices at which the stock has traded during the day. The volume is the number of shares that have traded during a day. And finally, the market cap or market capitalization is the total value of all of the outstanding shares of the stock on the stock market. This is calculated by multiplying the total number of shares by the price of an individual share and gives the rough value of the company. The final, most important part of a stock quote is the stock chart. A stock chart gives a visual representation of how a stock has traded throughout a day, week, year, or any other time frame. There are many different stock charts, but the main types are line charts, candlestick charts, and Heikin Ashi charts. A line chart is the easiest to understand type of stock chart, as it just shows the closing price over time during a particular time frame. A candlestick chart is also fairly easy to understand, but it has a little bit more information for any given time frame. On a candlestick chart, each candlestick represents a specific time frame. One candle can represent 1 minute, 5 minutes, 10 minutes, an hour, or more. The four main things that you see on a candlestick chart are the lowest price, highest price, opening price, and closing price of that specific time frame. If the change between the opening and closing price of a time frame is positive, the candle will be green, and if it's negative, the candle will be red. Candlestick charts give a much more accurate representation of what happened during a specific time frame than a line chart does, but they're also more difficult to understand and are not necessary for most types of trading. The final main type of stock chart is called a Heikin Ashi chart, and it looks very similar to a candlestick chart, but uses a much more advanced formula to calculate the values. This formula essentially gives a better idea of the trend of a stock price, but it is not necessary for pretty much anybody for trading. Within trading, there are a few different types of trading that most people typically use. These are scalping, day trading, swing trading, and position or long-term investing. Scalping is a short-term strategy where traders try to make quick money through trades that last anywhere from a few seconds to a few minutes. These type of traders typically rely on volume and specific market movements rather than any type of news or fundamentals of a company. The main pros of being a scalp trader would be you can make quick profits, you typically have a high win rate, you have fairly low risk on any given trade, and you can have a lot more trading opportunities. Since scalp traders are in trades for very short amounts of time, if they make money, that money does come very quickly. The high win rate is also similar to this, as most scalp traders use a very tight stop loss on their trades, and any movement in their direction will result in a profitable trade. It's also a fairly low risk strategy because of this tight stop loss, and scalp traders typically don't invest very much of their account into any given trade, meaning that they can't lose a large percentage of their account in any one trade. Finally, scalp traders have a lot more trading opportunities as they can take many different trades throughout the day and don't have to rely on one single trade making them a lot of money. The main cons of scalp trading would be the high transaction costs, the required discipline, the psychological stress, and the advanced skills necessary to be successful. Almost every brokerage has some sort of transaction costs on any given trade, and these transaction costs can add up when you're taking many different trades on a given day. Also, having a lot of mental discipline is required in scalping, and if you were to make a bad trade and not get out of it in time, you could end up losing a lot more money than you initially intended. This leads to a lot of psychological stress since you have to be constantly on while you're scalp trading, and this can lead to a lot of stress in your life beyond just trading. Finally, scalp trading does require a lot of knowledge of the market and how stocks trade on a day-to-day basis that is necessary to predict price action and identify different support and resistance levels that are necessary for making money with scalp trading. As a whole, scalp trading can be profitable, but it's for much more advanced stock traders and can be difficult to get used to. Day trading has a lot of very similar pros and cons to scalp trading as a whole, but there are a few differences. Day trades are typically defined as trades that take anywhere from a few minutes to a few hours but are closed within the same day. Because of this slightly longer time frame, day traders are typically exposed to more news risk and economic risk as a whole. This means that if you're in a day trade and an economic announcement comes out, such as a new federal funds rate, the market can move very drastically and affect your day trade position. Because of this, day trading is typically more risky than scalp trading and can have much larger losses as well as much larger gains than scalp trading. The next main type of trading is swing trading, which can be defined as a trade that you take that goes anywhere from a few days to a few weeks. The main pros of swing trading would be that you have more trade opportunities than a position trader, you have typically reduced risk, you have more flexibility, and it requires less time than scalping and day trading. Swing traders have more opportunities investing than a traditional long-term investor would because you can take advantage of shorter-term stock moves without having to constantly monitor your positions, such as a day trader. Swing trading is also typically known as less risky than day trading since you typically have less of your account in any given trade and you are willing to hold it for a longer period of time, so even if it goes down a little bit, it can still come back up. Whereas with day trading, you would typically sell those trades for a loss. Swing traders also have more flexibility than a long-term investor because you can get in and out of trades whenever you want if something were to go wrong with the stock that you're investing in. Another main advantage of swing trading is it requires a lot less time than day trading, since you can just research a stock, buy it, and then hold it as long as you want and sell it on any other day without having to constantly watch the stock price like you would while day trading. The main cons of swing trading are you typically have a lower win rate, you have lower potential returns, it still requires a lot of discipline and psychological stress, and it does require more advanced knowledge than a long-term trader. There's also the idea that you're taxed higher for short-term capital gains than you are for long-term capital gains, so any gains that you make while swing trading will typically be taxed higher than gains you would make with long-term investing. Swing trades typically have a lower win rate than day trades since you're not able to react to market movements as quickly, and overnight the market can move very drastically and you can't get out of a trade during that time. Swing traders also typically have a little bit lower potential returns than day traders, since day traders can get in and out of many positions and make money on all of them, whereas a swing trader would be still in the same one position overnight. Swing trading also requires a lot of mental discipline and can lead to psychological stress similar to scalping and day trading, since any stock that you're holding overnight can make big moves, which can be very worrying. Swing traders need to monitor their positions enough to know what's going on with their stock without being too overly invested that they'll essentially turn into a day trader. Learning how to do swing trading also takes a lot of advanced trading skills and knowledge, which includes the ability to interpret price actions similar to day trading, as well as identifying more longer-term support and resistance lines and being able to manage your risk effectively. These skills take a long time to develop and require a lot of practice, so swing trading is a lot more difficult to do than long-term investing is. As a whole, swing trading is a good in-between of long-term investing and day trading, as you can take advantage of shorter-term price moves without having to be constantly watching your stock as you would with day trading and scalping. This brings me to the final type of investing, which would be long-term stock investing. The main pros of long-term investing are the potential for high returns, heavily reduced risk, the potential for passive income, the lack of time and effort required, and the potential for better tax implications. The potential for high returns comes from the idea of compound growth, which is the idea that any amount of money that you have will grow year after year and over a long period of time will grow a lot. Also, given that long-term investing is over the course of many years, there's a lot less risk involved. This is because even if the market dips for a few weeks or even a few years, if you're willing to hold for a long time, the market will typically go up. With long-term investing, there's also the potential for passive income in terms of dividends, which will provide a steady stream of income regardless of how the market moves. Also, long-term investing requires way less time and effort than even swing trading does, as once you buy a stock, you can just completely forget about it and just leave it there for a long period of time. The final benefit of long-term trading is the tax implications, which is that any stock that you hold for more than a year counts as a long-term investment, which is taxed with a long-term capital gains tax, which is less than the short-term capital gains tax. So any amount of investing that you do that you hold for more than a year will be taxed at a lower rate when you go to sell it. The main cons for long-term investing would be lower liquidity, lower flexibility, lower control, and lower potential returns than other types of trading. Lower liquidity essentially means that you will be holding the same companies for a very long time, which means you'll typically have less money to invest in new opportunities at any given time. Since you don't want to sell your long-term positions and get taxed at a shorter-term capital gains rate, it's harder to get rid of stocks and get into new investments as you would want to, as you could easily with swing trading. This is also similar to the idea of having lower flexibility in a long-term trading account, as when you're long-term investing, you don't want to be getting in and out of positions constantly, so you have to deposit more money into your account to get into a new opportunity. Long-term investors also have a much less lower control in the stocks that they own, since if you're investing in a company long-term and things start to go wrong with the company, it's harder to get out of the company as you easily could with a swing trader. Since long-term investors are typically less reactive to market news and overall economic events, it is harder for a long-term investor to be reactive to potential news in the stocks that they're invested in. Finally, long-term traders have a lower potential return than day traders and swing traders, as day traders and swing traders can compound much larger gains if they're very good at taking good trades. As a whole, long-term investing is the easiest and relatively profitable strategy for new traders and experienced traders alike. Long-term investing is great for basically everyone, as it can take as much or as little time as you want, depending on how involved you want to be in the market. For very new investors, you can essentially just put your money into an ETF or mutual fund and completely forget about it, and you will likely still see growth in the future. More experienced investors can take a lot more time to research and dig into specific individual companies and potentially make more money. Long-term investing is typically what's recommended for anyone that's new to the stock market, as well as people trading through retirement accounts, as it's a very good strategy for long-term growth and sustainable growth in your account. All of these types of stock trading have a time and place, and every single one of them can be profitable for varying different people. So that'll be a wrap for this episode of Stocks with Connor. I hope you enjoyed this discussion about different types of stock accounts, what stock quotes are, and the different types of trading in the stock market. Remember that investing in stocks is a great way to grow your wealth over time, but it's very important to do your own research and understand the risks involved. Thank you very much for listening to this episode of Stocks with Connor.